Good day, everyone, and welcome to the third MFP Outcome Matters webinar for 2025. I'm Therese Grobler, Head of MFP Wealth Management, and it's great to have you with us today. MFP Outcome Matters was designed to do exactly what the name suggests, focus on the factors that truly shape client outcomes. Each quarter, we bring you market insights, portfolio updates, and really thought-provoking perspectives that help you navigate a fast-changing world with confidence. Today's theme then is the power of advice, backed by solutions that work. At MFP, we firmly believe that the value of advice grows when it's paired with the right solutions. That is why our sessions are built to reinforce the link between market context, our portfolio positioning, and really how these align with our wealth management philosophy. A philosophy that puts outcomes first, aligns with client goals, and actively manages risk. We really have an exciting lineup today, including market and fund updates, a deeper look at what's happening inside our portfolios that make up the flagship fund range, and an invaluable consumer perspective on financial advice from Professor Carel van Aardt. Before we begin, a few housekeeping notes. We have again applied for CPD accreditation for today's event. To ensure your attendance is properly verified, please view the full session and submit your ID number under the CPD section. The platform will remain open until the end of September, giving you ample time to revisit the content and earn your CPD points. Certificates will also be issued automatically once all our requirements have been met. As always, you are encouraged to please use the Q&A function to post questions during the session, and our speakers will either respond during or shortly after today's event. As mentioned earlier, we have an excellent lineup of speakers this morning. Our first session takes us right into the heart of the global macroeconomic environment. I'm pleased to welcome our Chief Economist, Sanisha Pakarasamy, and economist, Tiamo Masike. They will anchor us in the realities of local and global growth, exploring the geopolitical headwinds and market forces that shape our investment opportunities. Sanisha, Tiamo, over to you.
Thank you, Therese, and good day, everyone. We are past the first half of the year, but the fog has not lifted. The world is still grappling with trade policy flip-flops, keeping businesses, investors, and households on edge. At this point, uncertainty is not just lingering, but it is evolving. And we will unpack what that means for global momentum with Sanisha. I want us to first unpack the growth impact. How is this evolving uncertainty affecting global economic growth prospects?
Well, thanks, Tiamo. I think we can say that uncertainty is having quite a negative implication for economic activity across the globe, especially when we start thinking about tariff policy, the magnitude and the duration of these tariffs. Now, the International Monetary Fund has basically suggested that tariffs in themselves can be negative for growth. But the unpredictability of that tariff policy can be even more damaging for growth. So think about it from the perspective of a business. Now, a business has a lot of uncertainty around the consumers that will buy from them, and of course the suppliers and the health of their suppliers. And so they might actually bring in fixed investment and not really hire as many workers. And the same thing applies for a typical consumer in the global economy, roiled into the pandemic, and then of course more recently a cost of living crisis that came out from the two wars. Now they're going to face a lot of uncertainty around tariffs and what that means at the end of the day for the money in their pockets. And so from that perspective, businesses and consumers will be pulling back on spending, and that's quite negative for growth. Now, the IMF has said that if you just look at the uncertainty related to tariffs, that could pull off about 0.5% from baseline GDP and the level of growth this year, and about 0.8% for next year. So quite a big, meaningful impact. And of course, if we look across to the World Economic Prospects report from the World Bank, here they're basically looking at a growth rate of about 2.3% for this year. So that's quite weak. It's probably the lowest growth rate that we've seen in about 17 years outside of the recessions. And if we have to take into account what the World Bank's numbers are for the next couple of years, the 2020s are going to be the lowest decade of growth that we've experienced since the 1960s. The World Bank, since the beginning of the year, have downgraded about 70 of the economies that they look at, and about 60% of the economies are now expected to experience a slower rate of growth than we did see in 2024. So this uncertainty is really roiling economic growth in quite a big way.
I think, as you've just mentioned, uncertainty alone has a massive negative implication. And we know this is partly due to whipsawing tariffs. Since the sweeping duties on Liberation Day, we had the announcement of the 90-day pause, then product-specific tariffs, some country-specific deals already struck, and the 1 August deadline extension. This has resulted in changes to the effective tariff rate. Can you take us through these changes, and what is the market baking in at this point?
So I think it's quite difficult to really get a firm handle on what the market is baking in for tariffs. But I think safe to say that the baseline tariff of 10% that's been applied to all of the US goods imports will probably stay. The idea behind those tariffs was to ensure a more level playing ground in terms of trade deficits with the rest of the world, and also to start bringing back manufacturing to the US economy. On top of that, I think we will probably see the tariffs on Canada and Mexico prevailing because these have to do with national security. They want to limit drug trafficking into the country as well as limit the illegal immigrations across the border. However, we have seen some sanity prevail. And so when we look at areas where the US is still quite reliant, so think about the rare earth minerals that are produced by China. When they wanted to curb those exports, suddenly we had quite a big de-escalation in the tariff debacle there. And the same thing applies really with electronics. Now, if we think about areas that were quite hard hit, autos, steel, aluminium, the jury is still out as to whether or not we'll get quotas applied that will actually soften the blow of those tariffs. And I think ultimately there's still quite a lot of uncertainty around additional tariffs. So if we think about the European Union, they could potentially use this as a trump card and say, we can actually apply digital services taxes if you apply sector-specific tariffs on us. And this is quite interesting because up until this point, we've really only concentrated on tariffs in the goods department of global GDP rather than services. And we know that the US economy actually runs a trade surplus on services with a number of countries. And so this could be an angle that the rest of the world then takes. The other issue we don't have a lot of clarity on is on transshipments. So take Vietnam and the deal that they brokered with the US more recently. And the US came down quite strongly on Vietnam and said, if you are importing goods from China and then sending it straight on to the US, we would probably have to levy those goods. But again, it's very difficult to get an idea of the quantum of those transshipments. And so there's a lot of uncertainty around there. But I think ultimately what the market is pricing in is something that's a little bit softer than Liberation Day tariffs, but ultimately a lot higher than what we've seen in recent history. So this is going to have a negative impact on growth, as we've said, but it will also have a negative impact on inflation. And we've seen in the US economy already that the consumer price inflation is starting to now pick up on the back of these more onerous tariffs.
You brought up an interesting thought that goods have been the target of the tariffs, but there is still uncertainty about, for example, services, which could potentially exacerbate the disruptions. With what we know now, the ongoing bilateral negotiations, and considering the telco pattern, so Trump always chickens out, how could economic growth evolve?
It's interesting to kind of get a bigger range of growth forecasts from here. And again, we'll look to the World Bank's June report, where they basically look at a baseline growth number of 2.3%, but then look at an upside scenario and a downside surprise. Now, I think we can, fundamentally say that the risks to the downside are far greater at this point in time. And what the World Bank has then colored in for that picture on a downside scenario is to say that there's more policy uncertainty, investment is held back, we have financial conditions that deteriorate, potentially more geopolitical fragmentation, even the incidence of natural disasters having a bigger impact on growth. And in that kind of world, we would probably see growth being about 0.5 percentage points weaker than the baseline for this year, and about 0.4 percentage points lower for next year. So if you think about that baseline growth number of 2.3, and if you take off the 0.5, we're sitting with the potential growth rate in a downside scenario of 1.8. That would actually put the global economy into an outright recession. Now, on the upside, there is potential for a better than expected economic growth outlook, and the World Bank says that would probably come through from more fiscal spending. The fact that tariffs may actually be a little bit lower, so half of the baseline, which is about 14%. The baseline plus 10 percentage points is essentially what's baked into the negative scenario, so you can see that gap in the range there. And then in the upside surprise, they also talk about productivity enhancements coming through from AI and technology. And in that case, you'd get about 0.1 percentage points added to growth for this year and about 0.3 percentage points added to next year. But you can see in terms of that range, the downside surprises are more hefty on the downside rather than the upside surprises from here.
Yeah, I think with what you just said, that potential upsides are there, but downsides are more at play here. With that said, how are recession fears playing out?
That being said, that we do think that downside risks hold a bigger weight. Even with that in play, we do believe that the risk of a recession has come back quite significantly. Now, you might ask why, and I think part of that is because of just general tariff fatigue. And the other point that you made about taco. So I think investors, not really baking in the full extent of what Trump is proposing, as you might, chicken out from there on those policies. And it doesn't really matter which metrics you look at, whether it's market-based sentiment indicators or whether you actually go out and survey respondents. But across the board, we are seeing a lower probability of recession being penciled in. So if you take the New York Fed recession indicator, which is an analysis of the yield curve, taking a longer yield bond, the 10-year, less your 3-month yield, so that will give you a spread, and then converting that into a probability, we're now sitting with a probability of a recession that's about 29%. This was at 70% in April after the Liberation Day tariffs were announced. Again, if you look at the market indicators and we look at the Bank of America survey that looks at your fund managers across the globe, again, in April, half of them were saying that there's quite a big probability of getting a hard landing in the US economy in the next 12 months. This is now rolled back to about 1 in 10. So again, you can see that across the board, the market is assuming a lower risk of recession, even though this year is not going to be great in terms of GDP growth.
Okay, so chances of a recession seem to be very slim. Despite this, though, there's a lot of talk about US exceptionalism being at risk. Can you unpack US exceptionalism a bit?
Sure, I think it's quite important to kind of define what US exceptionalism is. And we like to bucket this into 4 approaches. So the first is really from an economic stance, because we know that, the US contributes about a quarter of global GDP. Secondly, we would also then look to the financial angle. And so we know here that the dollar has been the predominant reserve currency in the world for a number of decades. Thirdly, if we look at it from a geopolitical perspective, the military force and defense system in the US is quite a formidable one. They do contribute a lot to NATO spending and in terms of the US's influence in the world at global organizations, such as the World Trade Organization. And then lastly, from a technological perspective, the US has done a lot of that hard work in terms of spending on research and development and has built an ecosystem that's quite conducive for corporate profitability. Now we're moving into a more multipolar world. So we do believe that the US will still have influence, but we do believe that their leadership will now be shared across those other economies when it comes to things like the economy, when it comes to things like geopolitics or the financial system. I think where the US can still be a key leader is in the area of technology. And that's because they've done so much research and development spend, unlike, the UK or Germany. This also doesn't really take away from the argument that China is, of course, becoming quite a big rival in that space. But I think, the US in this area can still be a key leader in the global economy.
So given that 3 of the 4 metrics that you ascribe US exceptionalism to can be shared, what does this mean for the United States dollar?
I think it's going to be very difficult for the world to move away from the dollar very quickly. Just to sketch that out a bit, if we had to look at all of the foreign denominated debt in the global economy, about half of it is sitting in the US dollar. Half of global export invoicing is done in the dollar. About 57% of foreign exchange reserves are sitting in the dollar, and almost 90% of FX transactions across the globe
In the dollar.
conducted in the dollar. And so it's very difficult, for economies to actually move away from that mode of transaction. Also, if you try to think about who are the natural contenders, and here we can, focus on a chart we put together, looking at what the criteria are for a currency to become the world's reserve currency. We know that the dollar ticks a lot of those boxes, and you can see a lot of green on the chart for the US dollar. However, if you look to the euro, they fall short when it comes to the size of the Eurobond market, which is about less than half of the US Treasury market. If we go to the Japanese yen or maybe even the Swiss franc, even though these currencies do act as safe haven assets at times, it's a very small market, so there's not going to be enough currency for these foreign transactions to go through. And then lastly, if we think about the renminbi, China still has severe capital controls in place, which we know investors don't like, and not really a freely floating currency that's easily convertible. Maybe so in Asia, but not really the rest of the world just yet.
So I hear where all the other currencies are falling short. What about gold? We also saw recently that Basel III recognized gold as a tier 1 asset.
That's a good question. So, gold has really performed well as a safe haven bet as risk appetite has waned in the last while. But again, I think for the reason that it is a store of value rather than a means of transaction. And I think it will hit up against the same constraints as a Japanese yen or Swiss franc, which means that there's just not enough gold for those transactions to take place.
We know there's also been a lot of gold purchases by central banks recently, which has helped gold prices. Do you think there is further support for gold?
Yes, I think we can make quite a strong argument that emerging market central banks will continue to mop up gold in favor of the US dollar for their reserve holdings. And I think we saw a fundamental shift in 2022 when Russia invaded Ukraine, and we saw that America came down quite hard on Russia and froze a lot of their FX reserves that were denominated in dollar terms. And I think, emerging markets got quite nervous about that because if their relations with the US soured at any point, the same could happen to them. And so, places like China would probably prefer to have, gold bullion that they can store in their own country. And, to make that point about China, officially, they probably, hold about 2,200 tons. Unofficially, Bloomberg has suggested they probably hold closer to 5,000 tons. So this comes a long way in explaining why gold has actually run as hard as it has. But even if China has to get to the global average, which is about, a fifth of global central banks' holdings are now in gold rather than any other currency. If China had to get there, they're currently at about 5%. So even if that number had to just double and not get to that 20%, it does still mean that gold has further to run in the cycle.
Let's talk about the other elephant in the room, US fiscal. The one big beautiful bill, which prioritizes tax cuts and increased spending in certain areas, while reducing social welfare expenditure, was passed in July. And a big concern around the act is the negative debt impact. It's estimated to add more than 3.2 trillion US dollars to the debt over a 10-year period, which is quite significant.
To be fair, Tsiamo, the debt issue is not just a US issue. And so if we look at the typical country belonging to the OECD, the Organization for Economic Cooperation and Development, they've got an interest bill as a share of GDP that has basically gone up from 3% in 2021 to about 4% in 2024. Now, that might not seem like a big shift, but it's the highest that it's been in over 20 years. And it does also imply that governments today are now spending more on servicing debt rather than spending on things like the police force or defense or even housing. And that has a significant repercussion for structural reform in a number of markets. But I think what you're alluding to here is just around policy unpredictability, less flexibility around fiscal and monetary policy in this stance. And in terms of that big, beautiful bull act, if we continue on this trajectory, we could end up with a debt to GDP ratio in the US that gets to about 140% as a share of GDP by 2050. Now, this is problematic because currently investors are looking for a higher yield to compensate them for risk when they invest in US securities. And that means that the yield could go even higher in the future. But there's also quite an interesting interplay between fiscal and monetary policy at the moment. And so, there's a bit of what we call fiscal dominance. That implies that fiscal policy is running quite loose, and that prevents central banks from cutting by too much because they have to be quite aware of the inflationary impact of those fiscal policies. But then more recently, we've also had some indication around potential political interference in some central banks, like the US Federal Reserve. And I think markets are becoming very nervous around the credibility of the Fed to be able to maintain price stability in this current environment.
Speaking of that United States Federal Reserve, we know the chair, Jerome Powell, his term is coming to an end next year. And you touched on the political influence. What can we expect from here?
Well, Powell steps down in May of 2026, and what we can say up until this point, that him together with the other FOMC members, the Federal Open Market Committee members, have been quite circumspect about inflation risks, saying that they need to be data dependent, and really having quite a cautious outlook on interest rate policy, suggesting that maybe we get another 2 cuts from here because of those inflation risks. What the market has cottoned onto is the potential for him to be replaced by someone who has a far more dovish approach to interest rate policy in spite of these inflation risks. And I think this is where market participants are becoming quite wary around the credibility of the Fed and their ability to maintain prices at a stable level in this era of higher protectionist policies.
Let us turn to South Africa. You mentioned that fiscal woes are not unique to the United States, and South Africa has its fair share of challenges. We've experienced 3 consecutive budgets with upward revisions to the debt to GDP ratio. This is unsustainable, especially considering that SA's debt to GDP more than tripled since 2008, from 24% to above 75%. While government is pursuing fiscal consolidation and targeting a primary surplus, this does tighten spending and limits fiscal support for growth. At the same time, trade disruptions weigh on exports, and fixed investment remains weak, dampening near-term growth prospects. Some support is expected from consumers, aided by lower inflation, declining interest rates, and two-pot withdrawals, but pressure from bracket creep persists. At this point, medium-term growth hinges on structural reforms, which are driven by Operation Vulindlela, a body operating between the National Treasury and the Office of the Presidency. While post-GNU reform euphoria has faded, sentiment is improving, and reform should play a bigger role over time. Which areas of reform are you seeing movement in that could support medium-term growth?
We know that, during phase 1 of Operation Vulindlela, quite a lot of effort was put into areas of energy, logistics, water, visa, digital spectrum, and now they're expanding this to phase 2. Some of the projects, of course, that they did in phase 1 will be continued. So if we think about energy, quite a lot of effort was put behind restoring generation. Now they're looking at things like distribution networks and expanding on the transmission grid. If we think about water, quite a lot of effort went into reinstating the monitoring systems there. Now they'll be looking at improving private sector participation and getting a regulatory body on board. In logistics, we saw, quite a big portion of legislation coming through for the transport sector to enable more private sector participation to come through. I think we'll be seeing a lot more PPPs formulating in the next couple of years in things like ports or even just the railway network in general. And we'll probably also have a transport economic regulator that's put into place. If we look at the visa reforms, again, a lot of work was done under phase 1, but I think they'll really just be expanding on the remote worker visa system, as well as the points-based system for skilled workers. And then, of course, moving now into the era of phase 2, and what they're trying to achieve here is a big overhaul of local municipalities, which has been quite a choke point for many businesses in South Africa as they have failed to deliver on services. And so now they're looking at things like a trading system for water and electricity, professionalizing services, and really just improving the governance and overall financial situation of municipalities in South Africa. The second element of phase 2 focuses on the spatial issues. So this is bringing people closer to work opportunities, making sure that we have a fully functioning passenger railway system, ensuring that we can eradicate the backlog on title deeds for affordable housing. And then lastly, focusing on the digital aspect. This is really just enhancing digital payments. And I think this can be a complete game changer for township economies, as an example.
Yeah. But I think, as always, the challenge isn't the reform plans themselves, but rather the political will to implement. The GNU is currently fragile because of tensions between the ANC and the DA. While we expect the coalition to continue this year, we do not expect a lot of policy momentum. The outcome of the DA's leadership contest in 2026 and the ANC's one in 2027 will shape the policy and growth trajectory. The ANC battle may become more complicated given allegations on one of the frontrunners. Further out, we have the national elections, and the outcome of that, whether center-left or center-right, will matter a great deal. But for now, what are some of the things that can make us smile and be hopeful?
So we've mentioned quite a lot of the structural reform efforts that will generate a higher economic growth profile in the medium term. But maybe let's talk about, inflation. Given that this has been a bugbear for much of the global economy in the last while. And South Africa has actually been in quite a fortunate position where we've actually operated closer to the bottom end of our inflation target. I think this is really what's been behind the debate about lowering the inflation target, which we believe is a good thing in the longer term in order to improve purchasing power of consumers, ultimately eradicating poverty over a longer time frame, bringing in those debt servicing costs for government. That's really on the inflation front. I think what's also been aiding that, which is another bright spot in SA, is that we've actually had quite a well-behaved currency in spite of all of these global and local risks that have been playing about. And I think part and parcel of that is that our terms of trade has performed quite well. And part of that has been because gold prices have performed well and oil prices have been relatively subdued, even in light of the Israel-Iranian tensions that broke out earlier on in the year. Add to that, on the growth side of things, we've seen another unit of Medupi coming on stream about 8 months ahead of schedule. This really even lowers the risk of load shedding even more. If we think about growth in general, I think, one of the biggest drawbacks could potentially be the US tariffs if they do slap on the 30% across the board without maybe quotas in place. The bright spot here is that the US actually only accounts for less than 8% of our total exports. And we know that the Reserve Bank in March of this year calculated a few scenarios, one of which was a 25% tariff across the board on SA products that are sent to the US. And in that scenario, it whops off about 0.2 percentage points from growth. It's only really in a scenario where financial conditions sour significantly or the rand, falls out of bed for a prolonged period of time and sentiment really gets dashed in a meaningful way, could that detract about 0.7 percentage points from growth. So I would take that as a bit of a bright spot because we haven't actually seen the rand performing in that way, and financial conditions have, broadly speaking, upheld in this kind of scenario. And then lastly, I think one of the biggest bright spots to be quite happy about is essentially that in October of this year, we might find that South Africa has actually taken off the Financial Action Task Force's grey list. So there were 22 action items of which we've now completed, and the last hurdle is just to show political willingness to implement on those action items and to ensure that there's requisite financing for those crime combating institutions. And even though it may not, bring a massive amount of capital flows into the country, it will still help from a due diligence perspective, lowering costs there, lowering the time delays, and just overall, improving the reputation of South Africa in a global context.
To close off, the fog of uncertainty still hangs, but it's not all grey skies, both globally and locally. While it's not a boom story yet, it's not a bust either. Thank you to the viewers And thank you, Sanisha, for sharing your insights.
Thank you, Tiamo.
Thank you both for those valuable insights. Understanding the bigger economic picture really helps us make sense of the conditions our clients are navigating and reminds us why long-term thinking is so important in uncertain times. Next, we turn to Rupert Gissing from Equilibrium, our trusted DFM partner. Before I hand over to Rupert, I want to share an important update on our MFP flagship fund range, one that represents the final piece of a wealth management journey we've been on for some time. Over the past year, we've methodically aligned every fund in our MFP flagship fund range to our wealth management philosophy, focusing on diversification, risk management, and delivering strong client outcomes. The new MFP-focused unconstrained equity model portfolio launching on the 1st of September completes this alignment. It replaces the previous portfolio and, freed from Regulation 28 limits, is designed to pursue maximum growth. This truly unconstrained portfolio can flexibly adjust asset exposures, capture high return opportunities, and better navigate market cycles. At its launch, the portfolio will have a 50-50 split between local and global equities. The local equity carve-out will be managed by our trusted partners, while the global exposure will come through the Momentum Global Sustainable Curate Fund, as well as the Curate's Emerging Markets Fund. Our goal is simple: consistency, clarity, and alignment across all multi-managed solutions in the flagship fund range, and all grounded in our wealth management philosophy. This portfolio is a powerful tool for advisors. Rupert will now take us through the manager selection, allocation, and day-to-day management of the fund. Rupert, the floor is yours.
Thank you, Therese. Good day, everyone, and welcome to our quarterly feedback on our flagship local multi-asset solutions, the MFP Focus Model Portfolios, and the Momentum Focus Fund of Funds. Let's kick it off by taking a look at how markets performed over the past quarter, and importantly, what drove the action. The second quarter started with a significant surge in market volatility. Investors were on edge, reacting to uncertainty around global tariff policies and rising geopolitical tensions. The CBOE Volatility Index, or VIX for short, often also called the Fear Index, spiked over 50, more than double its long-term average of 20. But despite the rocky start, fears proved short-lived, and most major asset classes ended the quarter in positive territory. Global equities showed resilience. On April the 2nd, President Trump announced new Liberation Day trade tariffs, sending markets into a tailspin. The S&P 500 dropped by 12%, but by quarter end, it was up 10.8% in US dollar terms. Investor confidence returned, and a strong earnings season helped the mega-cap tech stocks to rebound. The Magnificent Seven outperformed the broader S&P 500 after a slow start to the year. Developed market equities, as measured by the MSCI All Country World Index, or ACWI for short, rose 11.5% in US dollar terms, translating to 7.8% in rand terms due to a weaker dollar. Emerging markets edged ahead, gaining 12% in US dollar terms and 8.2% in rand terms. Performance was supported by strong returns from Brazil, India, and South Africa. In bond markets, attention shifted to US fiscal debt sustainability after the 90-day tariff pause, and yield curves steepened across major economies. The FTSE World Government Bond Index managed to edge out a positive return of 4.6% in US dollar terms and 1.1% in rand terms. Global property also delivered, up 4.8% in dollars and 1.3% in rand terms. Back home, local property also rebounded after a bumpy start to the year, up 10.8% for the quarter and still nearly 26% year-on-year. The JSE All Bond Index gained 5.9%, supported by political stability and positive inflation surprises. Bonds across most maturities delivered returns above 5%. And while local cash yields are easing due to sharp rate cuts since late 2024, they remain attractive. The STEFI Composite Index returned 1.9% for the quarter and 8.1% over the past year. South African equities continued their strong run, both on an absolute and relative basis compared to other global markets. The FTSE JSE Capped Swix All Share Index climbed by 9.7% for the quarter and 24.6% over the past year. This was supported by the outperformance of precious metal counters such as PGM and gold companies that helped the resources sector deliver a 9.8% return over the last quarter, albeit after a bumpy start to the year. The continued strong performance of rand hedge stocks like Naspers and BTI meant that industrials also had a good quarter, up 11.8%. Financials and other companies with traditional exposure to the local economy lagged, but still delivered a positive return of 8.7% for the quarter. All three sectors, financials, industrials, and resources, have posted solid gains over the past 12 months, up 20.3%, 29%, and 30.6% respectively. In summary, quarter 2 of 2025 was a quarter of resilience. Despite early shocks, markets bounced back strongly, driven by policy shifts, earning strength, and improved sentiment. With volatility seemingly here to stay for the foreseeable future, I thought it would be valuable to spend a couple of minutes to unpack what it means for investors and you as the advisors that have to guide your clients through these uncertain times. While volatility can feel unsettling, it often reflects rising economic uncertainty and not necessarily long-term danger. But the danger lies in how we react to the volatility, as acting too quickly and with emotional bias can have far-reaching and permanent implications. Recently, as mentioned earlier, markets reacted sharply to a major tariff announcement by President Trump on the 2nd of April. The S&P 500 dropped by 10% in just 2 days, but then staged a dramatic comeback. On the 9th of April, the S&P 500 then rallied by 9.5%, one of the best days since 1950. But this isn't the first time we've seen such dramatic moves. For those of you that have been around for a bit longer, think back to 1987, 2008, or even as recently as March 2020. Each time the market rebounded, often with gains of over 9%. Volatility isn't a flaw in the market, it's a feature. From the global financial crisis to the COVID-19 pandemic, history shows us that uncertainty often leads to overreaction. As Mark Twain said, history doesn't repeat itself, but it often rhymes. And the rhyme here, volatility tends to emerge when investors are unsure about the economy and as a result, company earnings. Consider the following chart, which illustrates research done by BlackRock on the number of days per year where there are market swings of 2% or more. In 2008, 72 trading days saw swings of 2% or more. In 2017, none. These swings aren't just about losses, they're about markets searching for clarity. Take 2022, despite an 18% drop in the S&P 500, half of the most volatile days were actually gains. And historically, years with fewer volatile days saw average returns near 20% and stronger GDP growth. Here's one of the most important takeaways. The best and worst days often happen very close together. March 2020, during the initial COVID pandemic volatility, saw 3 of the worst trading days and 5 of the best, all in the same month. On March 16 alone, the S&P 500 dropped by 12%, but 1 year later, it had rebounded by 69%. Talking about volatility and missing days with big corrections is one thing, but what are the actual implications? Consider the following. If you invested R1 million in a JSE All-Share Index tracker 20 years ago in July 2005, everything would have gone well until the global financial crisis in 2008. Now, let's say the prolonged volatility eventually got the better of you and you disinvested at the lowest point around February 2009 and moved your money to the safety of a fixed deposit for 6 months. We assumed an annual growth rate of 8% for purposes of this illustration. If you built up the courage, or perhaps suffered from a fear of losing out, and then invested your money in the Aussie Tracker again around September 2009, and then panicked again in March 2020 with the COVID market crash, again investing in a fixed deposit at 8% per year, before getting back into the market and still being invested today. Now, over the 20-year span, you look at the end result and think you did pretty well, as your investment would have grown to just over 8 million rand. But what would have happened if you just left it, riding out the volatility and fully participating in all those up days in the market? Then your investment would have grown to over 12.7 million rand. That is a difference of over 4.5 million rand. Just being in the market for 1 year or 5% more of the time over 20 years of investing would have yielded a return of 57% more. Not a bad outcome for staying the course and following a disciplined approach. During the recent tariff-related volatility, something similar transpired in the impact on the returns, the Momentum-focused fund of funds and the MFP-focused model portfolios. From the end of February, before the March volatility in the run-up to the tariff announcement started, and then particularly the first 2 weeks in April. Despite the sharp market reaction, one can see that the recovery happened equally quickly. This chart tells us two things. Firstly, that our robust portfolio construction process clearly illustrates the risk and return behavior of the portfolios. The portfolios reacted in line with their asset class exposure and risk profiles. The more conservative portfolio, Focus 3, as illustrated by the orange line, was less significantly impacted than the more aggressive Focus 5, Focus 7, and Focus 7 unconstrained portfolios. But then the opposite also holds true on the recovery side. The more aggressive solutions participates in the recovery more meaningfully. Secondly, as at the 16th of April, the portfolios all recovered from the extreme levels of short-term volatility and went on to record a quarter of strong returns, as we'll unpack in the following slides. As we mentioned earlier, the best and worst days often happen close together. Long-term wealth creation requires perseverance through short-term disruptions. The focus solutions being constructed with an outcomes-based philosophy linking a return objective with a specific time horizon accounts for market volatility as it relates to the specific objectives and risk profiles. So that's one less thing for you to worry about. As financial advisors, the importance of guiding your clients to stay the course during uncertain times carries significant value. It truly is a team effort between financial advice and investment management to guide clients to successful outcomes. But more on the importance of financial advice from our guest speaker today, Professor Carel van Aardt, that will share valuable insights with us. Now, let's take a closer look at the performance of the focus solutions during quarter 2. It was a good quarter for the Momentum-focused fund of funds as well as the MFP-focused model portfolios. Our overweight position in local equity contributed positively to performance and also helped to offset the impact of the strengthening rand that detracted from the performance of global asset classes. MFP Focus 3 was up by 6.3%, while the Focus 5, 7 and 7 unconstrained model portfolios were up by 7.2, 7.9 and 8.4%. The Momentum Focus Fund of Funds delivered returns of 6.1, 7.2 and 7.9% for the quarter for Focus 3, 5 and 7. The strong quarterly performance also contributed to the performance of the solutions over longer time periods, as both the 12-month returns as well as the returns over the solutions' respective time horizons are all ahead of their benchmarks and peer groups. The only exception here is currently the Focus 7 fund of funds, where we are still slightly behind the CPI plus 5% benchmark and the multi-asset high equity peer group. This is mainly driven by a lack of consistent strong returns from growth asset classes like equity and property. We have, however, closed the gap and now lag only marginally. The MFP-focused model portfolios continue to deliver on the objectives since their launch 51 months ago, with all the portfolios outperforming both their benchmarks and peer groups over the period. In terms of the portfolio's return attribution, we will use the MFP-focused model portfolios as a proxy for our analysis. Strategic asset allocation, or SAA for short, will always be the main driver of returns as it determines the exposure to the underlying asset classes for each of the portfolio's respective risk profiles and time horizons. Our investment decisions, as reflected by TAA or tactical asset allocation, column B, added to returns over the period, while manager selection, column C, detracted. When we put all of this together, the returns over the past year, as mentioned earlier, were ahead of their respective benchmarks and peer groups. From a tactical asset allocation perspective, our overweight exposure to local equities contributed positively, while neutral to underweight positions in global cash and bonds also contributed. Putting it all together, our TAA calls added 0.14%, 0.17%, 0.5%, and 0.97% to Focus 3, Focus 5, Focus 7, and Focus 7 Unconstrained, respectively. In terms of manager selection, the Curate Enhanced Yield Fund, our cash manager, and the Momentum Flexible Fixed Interest Fund, which consists of 3 flexible bond mandates, managed by Coronation, Prescient, and 91 respectively, both contributed positively to performance. The Global Equity Building Block was also firing on all cylinders, with both the Coronation Global Emerging Markets Flexible Feeder Fund as well as the Curate Momentum Global Sustainable Equity Feeder Fund contributing positively to performance. The Visio Unconstrained Fixed Interest Fund, our other fixed income mandate that we only use in Focus 3, detracted. As a more conservative mandate in the fixed income building block, this is however expected as part of the diversification of the portfolio. In the local equity building block, the Fairtree Equity Prescient Fund detracted from performance, while the consumer discretionary and financial sectors were the key performance drivers during the quarter. Positions in Harmony, Aspen, Standard Bank and Kumba detracted. The 91 SA Equity Fund also detracted from performance. The strong run in the resources sector meant that the asset class, as measured by the CapSwix benchmark, was a tough environment for most active local equity managers to outperform during recent quarters. We then also still see the last bit of attribution from the Momentum Global Growth Feeder Fund coming through. Recall that we replaced this fund with the Curate Momentum Global Sustainable Equity Feeder Fund middle of last year. In terms of our quarterly outlook and tactical allocation positioning, we will maintain our current mostly neutral positioning with a slight tilt towards local equity. We continue to favor local over global assets. Our local market still screens cheap when looking at pure fundamentals. On the bond side, we also still see some value as real bond yields are still attractive. During times like these, we believe that the most prudent approach is to remain aligned with the strategic asset allocation, which can help to reduce the overall volatility in the portfolios. And then last, but certainly not least, as part of the ongoing evolution of our MFP Wealth Management Solutions, we want to share some exciting developments with you regarding our flagship multi-asset solutions, the Focus range, and specifically the MFP Focus model portfolios. We've communicated before that we are in the process of developing a solution in the unconstrained space that will replace the current MFP Focus 7 unconstrained model portfolio, with increased global exposure and the aim of delivering maximum growth. We are very excited to announce that this portfolio is now ready and open for business. With the changes in Regulation 28 a couple of years ago, allowing increased offshore exposure, it enabled us to structure the Focus 7 portfolio to reflect our ideal offshore exposure, considering the time horizon and return objective of the portfolio. This then also meant that the Focus 7 and Focus 7 Unconstrained portfolios were near identical in construction and strategic asset allocation. This created an opportunity to develop a differentiated multi-managed offering in the long-term capital growth space on the MFP Wealth Management Solutions list, where the return objective is high-growth equity solutions that aim to deliver maximum returns for periods exceeding a 7-year rolling term. And so, the MFP Focus Unconstrained Equity Model Portfolio was born. In a departure from our benchmarking for the Focus range, the portfolio will not have a CPI objective linked to it, as the benchmark will be 50% local equity, represented by the CapSwix All Share Index, and 50% global equity, represented by the MSCI All Countries World Index over rolling 7-year periods. We believe that this benchmark is an accurate reflection of the stated objective of the portfolio, as the strategic asset allocation is 50% local equity and 50% global equity. We then also have the flexibility to make tactical calls with a 5% overweight allocation either way to local or global equities. This portfolio consists of a combination of the local and global equity building blocks that we currently use in the MFP focused solutions, with long-term growth being the only objective, irrespective of volatility. As a result, the names that you see in the portfolio will look familiar. The local equity building block has proven itself since we implemented the changes, and it will also bring consistency in the building block across portfolios. The same goes for the global side, where we source the developed market equity exposure from the Curate Momentum Global Sustainable Equity Feeder Fund. The only exception here being the emerging market equity exposure, where we will use the Curate Momentum Global Emerging Markets Equity Feeder Fund that is now available to us. As we have been using this fund for quite a while in the fund of fund solutions, and will be transitioning to it in the rest of the model portfolios as well, in order to finalize our alignment of the two sets of portfolios, it was a logical decision to use this to include it in the construct year from the launch of the portfolio. As it is a new solution, we can't illustrate performance numbers for the portfolio, but we have, however, done comprehensive analysis based on asset classes, incorporating historical returns and behavior of local and global equity over time. As one can see in the chart, and in line with the nature and intention of a construct such as this, returns can be extremely volatile, but the relationship between risk and return does hold true. Over the past 25 years, as illustrated by the numbers on the right-hand side of the green area, returns have varied between high single-digit numbers to the high teens on an annualized 10-year basis. In other words, it illustrates the return per year if you stayed invested in a similar strategy for a minimum of 10 years over various time periods. Please remember that this is by no means an indication of what the portfolio will be able to deliver, but merely an indication of how a 50-50 combination of local and global equity has behaved over time. The important takeaway here is that while there is a need for aggressive investment strategies such as this, with the potential to be rewarded well for following a disciplined investment approach over an extended investment horizon, one needs to be aware of the possibility of extreme levels of volatility, especially so over the short term, but even so over the longer time horizons as well. We are very excited about this new addition to the multi-asset funds on the MFP Wealth Management Solutions list. If you want to find out more about the portfolio, as well as the operational aspects as it relates to the mandate, please reach out to your dedicated wealth management specialist, JP or Mirinda, that will be able to assist. Well, as they say, that's all folks. Thank you for watching and see you at the next one. Back to you, Therese.
Thank you, Rupert. Next, we welcome Richard Statley, Senior Portfolio Manager from Momentum Global Investment Management in London, who will help us navigate elevated market volatility, unpacking the policy uncertainty and the trade tensions that are driving recent movements. Richard, over to you.
Thank you, and thank you everyone for joining us. So we've seen, as it says there, elevated volatility driven by policy uncertainty and trade tension. But, as you may know, if you've looked at returns recently, it's not all bad. In fact, the markets rallied strongly despite all of this noise in the background. So let's go and have a look at exactly that. This is looking year to date, in fact. It's picking up global developed market equities, emerging market equities, developed market government bonds, and also gold. Now, gold is right at the top there, and in fact, it's actually distorting things because it's done so well year to date. So clearly, one wanted to have exposure to alternatives, But nonetheless, everything else I can tell you is rising from bottom left to top right. That means all asset classes going up. And actually, the return now from global equities, if you add together the developed market line, that's MSCI World, and the emerging markets line, the return together for all countries' global equities is about 10% this year to the end of June. So a very decent first half of the year for equities. And in fact, bonds haven't done too badly either. Q2, no exception, equities going up, bonds going up at the same time. Now, things going up shouldn't be a huge surprise to us. That is the natural course of things for investments. If you look over time, but in the natural course of things, equities probably give you about 2% in any quarter. Last quarter, they gave you 11%. Bonds normally give you about 1%, and last quarter they gave you more like 4%. So why were asset classes quite so strong during the second quarter? I think it's actually quite hard to explain. This is picking up some of the shocks we've had this year. We look at our vertical lines. First of all, the DeepSeek news, huge disruption to the established leaders within the AI sphere. That comes out at the start of the year. Markets have to navigate that challenge. Then we get Liberation Day and the American administration saying, look, we're going to do things radically differently going forward, as it applies to trade. Again, markets have to try and navigate that. And then more recently, that final vertical line that's picking up the Israel-Iran escalation and, in fact, the bombing at times of Tehran. So very significant challenges. Another one to note, of course, would be threats to remove Federal Reserve Chair Jerome Powell. So all of these things have been there, and yet equity markets have proven particularly resilient and continue to go up. I think part of the answer to that is certainly what's been going on with the dollar. The dollar has weakened. We're picking up here the dollar against the euro, the dollar against the British pound, and also against the Japanese yen. The line there that hasn't done very much, that's the dollar against the renminbi. So that's the only area where the dollar hasn't significantly weakened this year. This helps to explain returns, as we'll see in a moment, because you've had a great currency translation effect whenever you're quoting returns in dollars. A quick note to say we don't think this represents the end of the dollar. There's all sorts of things being said about where the dollar goes from here. It's not a dramatic, we think, shift in the global order at this stage. It looks instead to us just like simple, prudent diversification. We've always preferred to have less in the dollar than most investors. Possibly other investors are waking up to that reality and doing the same as us now, and hence the dollar has been a bit weaker. I said it's had a big impact. You can see that here in all instances. The left-hand column for each of these different parts of the equity market, that's picking up returns in dollars. The right-hand column then is picking up the local currency return. And you can see how translated into dollars, you've had much better, higher returns. As I say, the dollar weakness has been our friend this year, given we prefer to invest beyond exclusively the US and dollar-denominated assets. Where do markets go from here? A couple of quick comments. We are feeling a bit cautious in the shorter term. Why is that? Well, markets have this great run since Liberation Day. So initially they fell and then they came out very strongly, and hence we have that very strong second quarter for global equities. That's the first reason I think to be cautious. You could well see a bit of profit taking. They weren't cheap going into this year either, and that's what this chart is picking up here. It's showing you essentially the price paid for equities, and that's by looking at the price and comparing that against the earnings you're going to receive. So this is the price to earnings ratio for these various markets. You can see why we're a bit wary of the US, because it is the market that most clearly has got expensive or more expensive over the 10 years picked up by this chart. So as I say, markets weren't cheap. And then finally, barriers to trade aren't costless. And while there's been a lot of positive talk about where we might ultimately land in some of these tariff rates between the US and its trading partners, there is still a cost that someone is going to have to bear. Not only that, we've seen some signs of softness in the US consumer. On the left-hand side here, that is consumption expenditure, so consumer spending. And in simple terms, you can see the chart is trending down from top left to bottom right. That is consumers having less and less room to spend. On the right-hand side is picking up the housing market index, a big source of wealth for US households, as it is everywhere in the world. With that trending down, that is another source of pressure. So this is another reason to be just a little bit cautious. But balanced against that, as I've said for a while now, is the fact that we're in this high return world. At the top there, you're getting about 4.5% on a US government bond, 10-year treasury. At the bottom there, you're getting about 2% in real terms on the same 10-year debt when lent to the US government. 2%, ignore all of what's happening to inflation. It doesn't matter if it's 10%, it doesn't matter if it's minus 10%, you will get that guaranteed 2%, as long as the US government doesn't default, which I'd say is a next to zero probability. That's a decent return. And as I say, in nominal terms, it's that much higher at 4.5%. So given that backdrop, it's a good time to be invested. Rates of return are high. So overall, we're constructive on markets, but somewhat cautious just in the short term, given the run-up we saw last quarter. Okay, moving on to the portfolios then. A reminder, here are the multi-asset portfolios that we managed. A cautious fund. If you're looking to invest for about 3 years, then that could be appropriate. A managed fund, that's for when you're looking to invest a bit longer, for say 5 years. And then so on, you've got a growth fund at the top there, and that takes about 7 years, or you'll need about 7 years if you want to invest in that. Now, around that, if you don't have 3 years, you've got a shorter period, we also have investments that may be suitable for that shorter term time horizon. And right at the far end, if you're saying, look, I'm not that interested in multi-asset today, Richard, I want pure equities, then again, we have a whole range of pure equity funds. So please, if you're interested in these multi-asset funds, if you're interested in other funds that don't quite conform to these time horizons, then just reach out to whoever you've got the best relationship with at Momentum. Indeed, reach out to me if you need to, and let's have that conversation. So there are the portfolios. I always do this as well. This is just proof of concept, longer term returns versus the targets we've set. Those targets are to outperform cash on an annualized basis, so every year to outperform cash by, in the case of cautious, 2.5% a year. In the case of managed, by 4% a year. You want 4% more than cash could give you each year, and rising again to 5.5% in the case of growth. When we look back to when we launched these in 2008, have they managed to deliver those kind of returns? I would say yes. Very clear that at the top there, growth, managed, both of them have in fact done better than the targets we set. Cautious, a little bit behind at the bottom there, but very clearly tracking that target. So it's giving you those types of returns. So when you're thinking, do I want to take a portion of my money offshore? There is that option to take a bit more risk than cash and to generate a bit more of a return than cash. And that's exactly what these portfolios offer. Turning here to the quarter, a really strong quarter then. Momentum Global Cautious at the top there. It returned in the 3 months to the end of June. It returned 6.4%. That rises to 8.7% in the case of Momentum Global Managed, and then on to 10.9% in the case of Momentum Global Growth. Was that better than the targets we've set? Yes, it was. You can see that by looking in each case at the second line down, which is our first reference rate. The second one is, did we do better than peers? And again, in the case of all three portfolios, yes, we did. So very quickly, if you take Cautious at the top, it did 6.4% over the past 3 months. Global Cash plus 2.5%, that would have given you 4.9%. The peer group median, so the average of what other people are doing, that did the lower 4.3%. So a very decent quarter, not only in terms of the returns people actually got, but also in terms of how we tracked versus those reference rates. Exactly the same picture when you look at 1 year. So it has been a decent year for the portfolios. That has been helped by some of the bigger themes we've seen in markets, like that degree of dollar weakness and like the emergence of other markets beyond just the US stock market. We've been talking about it for a long time, that we wanted to see investment returns coming from a range of areas, not just the Magnificent Seven. With that happening, so duly, returns have started to look really quite decent. If we look at the quarter in just a little bit more detail, what I'm going to use here is the fund in the middle of the range, so Momentum Global Managed. How did it compare versus a 60-40 equity bond portfolio? Because ultimately that's a pretty simple multi-asset construct and a fair way to compare our performance. And so yes, we did well. It was pretty much on par with that 60-40 equity bond portfolio. So alpha, there was a little bit, but it was pretty negligible. So what happened? Well, asset allocation, we're now looking at the right-hand side here. Asset allocation, not a lot going on there. I can tell you that on the one hand, we did well by virtue of our positioning within fixed income, some of the asset class we own there, like loans and short-term credit. We also did well by virtue of holding less in the US dollar, which continued to be weak. But that was balanced, was offset by our overweight to China, and China essentially went sideways over the quarter, and so we gave back a bit of return there. So asset allocation, nothing doing. Manager selection, well, we'll go on and look at that in a moment. That was positive. Added all together, including fees, and as I say, essentially no alpha, but obviously still a very decent absolute return. Here is what happened with manager selection. So manager selection gives you 0.5% in Momentum Global Managed last quarter. The biggest contributor, our best performing manager therein, was Schroders Recovery. That's a UK equity strategy managed by a name I'm sure you're familiar with in Schroders. That represented 20 basis points of that 0.5%. And that is because the third column you can see here, Schroders outperformed the UK equity market over the quarter by nearly 12.5%, a very decent return. The biggest part of that in their portfolio was stock selection within financials, and that's what the final little column and associated note is telling you there. So a very decent return from Schroders, and overall our underlying managers did a decent job, hence that positive 0.5% contribution to performance from manager selection. Going back then to returns, we've looked at the short term, 3 months. We spoke also about the 1 year. If we look now at the longer term, 3, 5, and 7 years, we see in the case of managed and growth, this has been the case now for a number of quarters, those funds doing a really decent job. They're pretty much ahead of their reference rates and peers over most time periods, with just a few exceptions. So doing a decent job. Cautious, still a little bit weaker, but very much in line with peers and steadily catching up with its cash reference rate. And that's because we've delivered some high returns. I should say, as I've done before, why is cautious a little bit weaker? It's weaker because it's a more cautious fund. It had more in bonds during that big sell-off in 2022 when the inflation outlook changed very dramatically and bonds did poorly. That's why that fund struggled in the short term, but it is right back to doing what it should be doing with a very decent return over the past year. With that, there are some very important notes. And all that's left for me then to say is a big thank you. So thank you for joining us.
Thank you, Richard. Your global perspective always adds depth to these discussions. Now let's shift our focus to Curate Investments, who are responsible for the single managed solutions included in our MFP fund range. Ali Simpkins, Head of Proposition, will take us beyond the numbers in the Curate Fund update, highlighting both the performance as well as the strategic positioning that make these funds a valuable complement to our multi-managed portfolio suite. We look forward to hearing your perspectives, Ali.
There is an intersection between art and science, a place where data and research come together with instinct and experience. This is where Curate lies, where the science of knowing what to do meets the art of making it all come together.
What is to curate? To curate is to be the custodian of very important assets. Now that works very well with what we do because we do two things and we do them very well. Firstly, we take care of things that are important to you. We take care of our clients' wealth. And secondly, we give you the comfort of knowing that we've done really hard work to find the best people to manage your money.
In a world that's noisy and uncertain, we focus on simplicity. We don't claim to predict what comes next. Markets shift, narratives change, and uncertainty is part of investing. That's why we look beyond the numbers to find great people who embrace this approach of simplicity. In a world full of options, we aim to simplify. Our fund range is focused and intentional, carefully selected to offer relevant funds, managed by people we handpicked to take care of your money.
Just like you've trusted us, we trust the investment managers that we've chosen to take care of your money.
It's about thoughtful selection, not broad assembly, giving you a clear and considerate place to start. This is Curate, the art of investing.
On the 1st of August, we celebrated 1 year of Curate Investments. And on behalf of the whole Curate team, I would like to thank you for your incredible support throughout this journey. We look forward to partnering with you for many more years to come. Good day, everyone, and thank you, Therese. In this session, we'll take a closer look at each of our funds and unpack their positioning as at the end of June 2025. As a reminder, the next 2 slides summarize our fund range and the specialist managers behind each strategy. Starting on the local front, our cash and income funds managed by Momentum Fixed Income are ideal for clients seeking capital preservation, liquidity, and income. The Curate Momentum Balanced Fund, managed by Visio Fund Management, blends growth and stability, ideal to use within retirement products as it's Reg 28 compliant. And finally, our property and equity funds, managed by Sesfikile Capital and Laurium Capital respectively, are designed for long-term capital growth, with both local and global exposures. Complementing our local offering is a set of international strategies that will help clients diversify globally. Robeco manages our global sustainable equity and emerging markets equity funds, offering cost-efficient, developed and emerging market exposure. These mandates can also be accessed via RAND-denominated feeder funds. Rounding out our global offering are our style-specific strategies, including the Curate Global Value, Growth, and Quality Equity Funds, exclusively managed by Lyrical Asset Management from New York, Jennison Associates from Boston, and Evenlode, based in the UK. Let's start by unpacking the funds aimed at generating income and liquidity. These comprise of the Curate Momentum Enhanced Yield, Flexible Income, and Income Plus funds, managed by Momentum's fixed income team. Let's start with the Curate Momentum Enhanced Yield Fund. The team maintained the fund's overall positioning during the quarter, while selectively increasing fixed rate exposure to lock in higher yields ahead of the South African Reserve Bank's decision to cut rates for the second time this year. In response to the declining interest rate environment, the team remains focused on uncovering alternative opportunities, such as credit instruments, to support and enhance returns. Over the past quarter, the fund continued to outperform both its benchmark and peer group, delivering an annualized return of 9.62% over the past year. The Flexible Income Fund also outperformed across periods, delivering an annualized 11.16% for the year. The fund's nominal government bond exposure and credit positions drove performance over the quarter.
The South African Reserve Bank cut interest rates in May as inflation remains stable, and a stable rand helped to ease inflation pressures. A boost also came from decreasing political uncertainty, as the proposed VAT hike was stopped and the federal budget was passed, which compressed South Africa's risk premium, which benefited credit exposures. In terms of the Income Plus Fund, this also aided the Income Plus Fund, which delivered an annualized 10.31% for the year. The largest contributor to the return this quarter was a Eurobond investment to a South African bank. The team gradually built this position over the past 3 quarters, taking advantage of a pricing gap. In other words, the same bank's bonds were trading at less attractive levels in South Africa than in the Eurobond market. We're also pleased to share more good news about the Curate Momentum Income Plus Fund. The fund's A-class now boasts a 20-year track record, a significant milestone in demonstrating the strategy's resilience and consistency. As per the chart, it illustrates the distribution of monthly returns over the past 2 decades. The fund has delivered positive performance in nearly every month, recording 229 months of positive returns over this entire period. This level of consistency speaks volumes about the robustness of the investment approach. Moving to the funds that aim to solve for capital growth requirements, such as the Curate Momentum Balance Fund, managed by Visio, which focuses on medium to long-term capital growth. The fund delivered a strong quarter, supported by the manager's decision to remain overweight in local and global cash, amid uncertainty around US tariffs. This positioning enabled the portfolio to quickly deploy capital and capture opportunities as markets rebounded. At the same time, the cautious stance reflects the manager's ongoing focus on capital preservation. As shown in this chart, the Curate Momentum Balance Fund has captured more of the upside in rising markets while limiting the downside participation during market declines. This has resulted in stronger outcomes compared to its peers to date. The Curate Momentum Equity Fund, managed by Laurium Capital, continued its strong performance this quarter, with returns again driven by exposure to platinum group metals and gold shares. Commodity prices surged to around $3,400 per ounce, and Laurium believes this will positively influence South Africa's terms of trade, ultimately supporting local consumer demand. The fund is well positioned to benefit, with meaningful allocations to gold and PGM counters such as Anglo Gold, Impala Platinum, and Northern Platinum. As a pure equity fund, it certainly supports wealth accumulation needs. Similarly, the Curate Momentum Property Fund, managed by Sesfikile Capital, was also designed with that need in mind. It is one of the few South African mandates with access to both local and global listed property. This broader opportunity set enhances return potential, with the fund able to invest across 16 international property sectors versus just 5 locally. This chart shows that the global portion of the portfolio is currently positioned to benefit from a number of themes. It's overweight malls, which continue to perform well as consumer spending improves and more retailers return to the physical stores. There's also a growing demand for residential property rentals, driven in part by millennials who are finding it increasingly difficult to enter the housing market. The fund is also overweight healthcare real estate, a sector underpinned by necessity-driven demand, where an aging population requires housing. And finally, the rise of generative AI, which is fueling a surge in data center investments as companies scale up infrastructure to meet growing digital needs. Moving on to our international funds that provide long-term growth and global diversification opportunities. This includes our Curate Global Emerging Markets Equity Fund and Curate Global Sustainable Equity Fund, both managed by Robeco from the Netherlands. The oldest share class of each of these funds turned 5 this year, and over this period, the funds have outperformed the MSCI Emerging Market Index and MSCI World Index respectively, a significant accomplishment indeed. Both strategies follow an enhanced indexing approach. This allows the portfolio to generate additional returns through small, deliberate over- and underweights relative to their benchmark. ultimately providing broad market-based exposure at lower cost. Moving to Curate's global equity style funds that were launched in September 2024. Firstly, the Curate Global Quality Equity Fund, managed by Evenlode, continued to deliver steady performance with no major portfolio changes. The focus remains on high-quality, capital-light businesses with durable competitive advantages. As for the Curate Global Value Equity Fund, it outperformed despite value stocks lagging growth stocks. Lyrical Asset Management used the market dip to buy high-conviction names. Equally, the Curate Global Growth Equity Fund, managed by Jennison Associates, had a strong quarter, rebounding from the technology sell-off during the first quarter. This creates opportunities to increase exposure to key names like NVIDIA, Microsoft, and TSMC. We look forward to sharing these funds' one-year performance figures with you next quarter. In summary, this is our fund range. Each Curate fund is managed by one specialist manager, ensuring focus and dedication. Additionally, our funds aim to address specific needs aligned with the MFP wealth management strategy. If you'd like to explore any of these funds in more detail, please connect with your regional fund specialist. We'd welcome the opportunity to continue the conversation and support you in meeting your clients' needs. Thank you for your time.
Thank you, Ali. A strong investment philosophy also depends on clarity of roles. Please join me in welcoming Janine van Heerden, who is the Head of Business Development at Momentum Securities. She will take us through Built, Not Bought, clarifying the role of a financial advisor versus a portfolio manager in constructing client solutions. Janine, please go ahead.
Thank you, Therese, and welcome everyone. Today's session is themed Built, Not Bought. Just like high-performance cars, great investment portfolios aren't bought off the shelf. They're custom built. We'll explore the roles of the client, the advisor, and the portfolio manager, and how our collaboration creates something truly customized and powerful. Let me tell you a story about Rolls-Royce, a share we hold in our global equity portfolio. Rolls-Royce was founded in 1906 by Charles Rolls, a wealthy motor enthusiast, and Henry Royce, a self-taught engineer. Royce built a car so smooth and silent that Charles immediately suggested that they build these cars together, and they quickly earned a reputation for building the finest cars in the world. Each car is a masterpiece, with no two cars alike. They even match the wood grain by sourcing panels from the same tree, and clients can choose from over 44,000 paint colors. So why Rolls-Royce? Because with thousands of customizable options to invest in, it reminded me of your clients. Each has a unique journey. Each person has a different problem they are solving for. And I believe that the worst thing that you can do is to force a client into a cookie-cutter solution. We are here to help you match your client's needs with the tools available to you and perhaps add an extra sparkle to the investment. We want to build them a high-quality, high-performance, unique vehicle to get them to their destination. Have a look at this video to see what else sets them apart. Imagine how different your morning commute would be if this was yours.
Hold your breath and count to 10. Feel the earth moving in. Hear my heart burst again. For this is the end.
if you think of an investment portfolio as a high-performance car, much like the Rolls-Royce you just saw, then I want you to meet the team building and driving it. These role players are going on an investment road trip together. The client is a car owner. They set the destination, which translates to financial goals. And they also decide how fast they want to go, which speaks to their risk tolerance. They might not know which road to take, so we need the advisor. See yourself as the GPS, even the driver. It is your job to translate the client's destination into a workable route and prevent them from going off track. You also act as a builder, helping the portfolio manager select the appropriate parts based on the client's needs and goals. You help the client navigate market conditions and keep the trip smooth and steady. The portfolio manager represents the mechanic, and he has the backing of his pit crew. They don't tell the owner where to go, but they build and implement the plan and keep the engine running based on the information provided by the advisor. The parts of the car we use are shares, ETFs, structured products, bonds, and other investment solutions. The vehicle itself is the investment structure, such as endowments and retirement products. Each role player has a distinct role, but we need to work together if the car is going to reach the destination in one piece. Let's discuss each of these role players and their role in the journey in more depth. The client is ultimately the one that makes the final call. They might not understand how the car works or how to read the road signs, which is where you come in. Clients don't buy portfolios. They buy confidence, clarity, and control. They ultimately steer based on the trust in the crew. They expect performance, but what they will remember is the ride. They need guidance, technical support, and transparency. And when we all work together, the owner feels in control, even on the most challenging roads. It goes without saying that if we don't set the correct destination, we won't reach it. It's also imperative to understand whether the client is a nervous passenger. We might want to adjust the course to ensure a smoother ride, or perhaps select a different vehicle. I've seen too many times that clients are placed in the incorrect vehicle with the wrong parts, which only creates mistrust and an unhappy client. You should consider some factors before placing a client in a share portfolio. With a share portfolio, the client has the option to build a customized portfolio compared to a unit trust that offers a one-size-fits-all option. Clients will have direct ownership in a company within a share portfolio compared to a pooled ownership in a fund. Some clients prefer having a direct client communication with the portfolio manager, something that is rare when investing into a unit trust fund. Costs and fees are completely transparent with a share portfolio, and this can be nerve-wracking for some clients. However, these costs are hidden within a unit trust fund as they are priced in the unit prices. Clients opting for share portfolios prefer to have the control and the ability to see each holding. But with a unit trust fund, you will only see the top 10. Of course, other factors like CGT harvesting within the share portfolio are potentially another benefit the high net worth clients prefer compared to unit trust funds, where there's no CGT implication when changes are made within the fund, and it only becomes payable when the client sells out of the fund. We find that high net worth individuals also prefer to reduce their individual risk by deploying derivative hedging, rather than being limited to the asset manager's discretion within unit trust funds. Of course, the biggest reason clients into a share portfolio is to pair it with other investments that are managed without the interference. Yet, they want to add a bit of sparkle to their investment by either protecting or enhancing the returns. This also gives you the edge when talking to clients, as most clients don't know you have a portfolio manager as part of your offering. And this allows you to build a completely personalized portfolio for your clients. Even for your clients starting out, the share portfolio can be constructed in such a way that is cost-effective and diversified. So it's not always only accessible for the high net worth clients. It is available for anybody wanting to have a bit more control. What we really offer the client isn't just returns, it's confidence. Placing them in the correct vehicle with the correct parts is crucial for retention. Even the best car would be lost without a navigator. Your role is to consider road conditions, aka market conditions, or speed limits, in other words, risk constraints, and even anticipate pit stops like life events, such as retirement or buying a house. You are ultimately responsible for translating goals into the long-term route. You help the client avoid potholes, like making emotional decisions. You play an important role in bridging the gap between technical and personal sides by acting as the middleman between the client and the portfolio manager. As an advisor, you are much more than a map. You are part GPS, part therapist, and sometimes part driving instructor. You help the client zoom out, avoid knee-jerk reactions, and stay the course. When markets go sideways or the clients want to veer off the road, you're the calm voice saying, recalculating, here's a better route. You understand the emotional engine as well as the financial one, and that's a superpower. You help plan the overall strategy, the kind of car to use, what road to take, and when to adjust the route. You would do this by following the normal 6-step financial planning process, which I'm sure I don't have to explain. But just quickly, as a gentle reminder, here are the steps. First, you're going to start off with a client introduction and establishing the relationship, gathering financial information and determining goals, then analyzing and evaluating the financial situation to determine strengths and weaknesses. You will then present your analysis and recommend your advice. Fifth is implementation and the financial action plan, with the last step to review and monitor the plan and make adjustments as needed. You should consider an investment that will speak to the client's needs. Investigating and comparing the investment options by taking the following into account: ease of access, the investment amount, impact of fees, investment components, tax implications, estate planning, liquidity requirements, and the time horizon. You then develop your plan based first on the structure you believe to be the best vehicle for this client. Then you will proceed with the asset allocation by examining the underlying investment options available, building them from structure to underlying funds. And as you can see here, it is crucial for you to have a clear understanding of not only the relevant structures to use, but also the underlying investments. You don't need to be the expert, but you need to be able to understand where it fits in. In most cases, advisors will contact us as part of this process to see if an alternative investment option is available that might just give you the edge without pushing the client outside of their risk profile. And this is where the real discussion happens. The advisor, client, and portfolio manager will look at the options available to provide the client with the outcome as determined by the client and shared with the advisor. You see, this is where clear communication is required from all parties to ensure that the correct parts are put into the engine you are building and that it is possible to implement within the framework determined by you as the advisor. Advisors would typically allocate funds to Momentum securities as part of the overall strategy for the client. They will blend house view funds with a share portfolio to provide the client with a unique portfolio built in accordance with their financial goals. The share portfolio is not there to replace any other functional parts, but rather to enhance them, like adding a bit of turbo to the engine. During the same interaction, you will determine how often the investments must be reviewed to ensure that it's still on track to reach the predetermined goals. The advisor must hold the portfolio manager accountable for delivering what is promised and communicating any sidetracks that might come along the way from the client side. It is just as crucial for the portfolio manager to speak to the advisor about changes in the terrain, aka market conditions, that might impact the client. Your role during turbulent times would be to be the voice of reason and prevent clients from going off the rails. Yeah, it is very important for the advisor and the portfolio manager to work together. If you don't, you risk losing the client's trust in the vehicle and that he no longer has the confidence to proceed with the ride. It is just as crucial for the client to communicate clearly from start to finish to ensure that all parties are lined up to reach the same end goal. The portfolio manager represents the mechanic and the pit crew. They are responsible for executing the trades and maintaining the engine. They know the machinery and they don't tell you where to go. They rely on your direction. They ensure that we reach the destination without the wheels falling off. They are the unsung heroes of the pit lane. A portfolio manager doesn't navigate, but he handles the tools and the parts with precision. Without a solid pit crew, even the best strategy falls flat. The key is partnership, not a handoff. Advisors and portfolio managers work in sync. That's how you build something that lasts. Portfolio managers need the advisor, as they are also at risk of losing a client if the advisor doesn't play their part. It is a requirement that the advisor understands our role during this investment road trip. We work with different types of mandates. Understanding how each work is essential. We have the execution-only or self-managed mandate. This mandate is typically used when a client is either starting and is exploring the share market before making a serious investment, or on the other side of the spectrum, it can be used by those that are super informed and have the know-how to manage a portfolio themselves. Momentum Wealth does not allow this type of mandate when a client is accessing a PSP on platform level, mainly because it's believed that advice is crucial as part of a client's investment road trip, and they should not be managing a share portfolio themselves, just like they should not exclude the advisor when selecting an investment vehicle. Next, we have the discretionary mandate, also called the managed mandate. This mandate places the client within any of our off-the-shelf models and allows the portfolio manager to make changes to the portfolio without getting permission first. It enables the portfolio manager to act quickly on market opportunities without being delayed by client decisions. These models are easy for the client to track, and we offer monthly fact sheets to see how the ride is going. Even though these models hold the same shares, each client's experience will differ due to each portfolio starting at a different point. The portfolio manager has the right to even phase the investment into the portfolio instead of making a call at a specific point. Lastly, we have the bespoke or advisory mandate. Here, we allow the client to almost co-manage the portfolio. We might start off with one of our models, but we won't make any changes without the client's permission. This is also typically the type of mandate we will use for clients wanting something different that falls outside of the model portfolios, like including crypto ETFs, for instance. We are also governed by the Phase Act, which means that the advice that we provide within the share portfolio has to follow the exact same process you have to follow as an advisor. For this reason, we also do a needs analysis and provide our license disclosure to clients. The PSP is our responsibility, as our license takes the risk. Now, building the machine is where the magic happens. Clear communication on the goals is key to alignment. A well-built portfolio matches the terrain, which represents the current market conditions. It provides good suspension by providing diversification, and it avoids blowouts by lowering overexposure. It also avoids hype chasing. Clients often sit with high-performance portfolios that they drive as if it's a Prius, without realizing the power that's under the hood. Often, portfolios we take over are underused and misaligned. The portfolio manager's role is to ensure that the client receives the maximum output from the built engine. Preparing a proposal for a custom-built portfolio is not just a push of a button. It takes time, much like the hand-stitching of the Rolls-Royce interior. So please don't expect that we spit out proposals. It takes time and it needs precision. Built portfolios outperform bought ones when the client is heard, the advisor is clear, and the portfolio manager is sharp. As you can see from this process, the mechanic does not speak to the car owner directly. The driver is always the first contact and communicates the client's needs to the mechanic. The driver is also responsible for communicating with the owner during good and bad times, as you need to manage the client's expectations and ensure that trust remains in the process. Clarity of each role reduces friction, boosts trust, and drives retention, letting the gears move smoothly. When each role is clear and the communication flows, the portfolio becomes more than just a collection of assets. It becomes a custom-built machine designed for one driver and one journey. Why does it matter? Because we want the clients to come back for the next trip. So let's stop selling cars and we start building journeys. And finally, you can buy a fast car, but without a driver, a navigator, and a mechanic, you're not winning the race. Make the client the hero, but build a team that makes them feel safe during the journey and inspires confidence. Let the portfolio manager focus on the construction and precision. Let the advisor handle the road, terrain, and pace. And let the client enjoy the ride, empowered and informed. Investments aren't plug and play. The real value is built, not bought.
Thank you, Janine, for a great overview. It really is clear how the combined roles of the advisor and the portfolio manager enhance the depth and the personalization of our MFP Wealth Solutions offering, especially for clients with more bespoke investment needs. That focus on delivering meaningful client outcomes ties in perfectly with our final session today. I'm really pleased to introduce Professor Carel van Aardt, Chief Operating Officer of the Bureau of Market Research, who will share market insights from the latest Momentum-BMR Household Finance Survey, highlighting the client's perspective on financial advice. Prof. Carel, over to you.
Good day, everybody, and thank you so much, Therese, for this wonderful opportunity to share with you our research that we conducted on behalf of Momentum that focused on the view of the consumer with respect to financial advice. So what I'll be focusing on today would be 7 focus areas of the presentation that have been phrased in questions. The first question is that what are some of the findings from the Momentum-BMR Household Finance data on financial advice? Secondly, how should the Momentum Group define advice and its various dimensions? Thirdly, how can Momentum Group define and evaluate the current and future value of advice? Fourthly, how is advice leveraged by competitors and where are the open spaces? Then fifthly, on how can Momentum Group make advice more accessible and attainable? And then a very important issue is that is advice the mechanism to access new and underserved markets? And then we'll conclude with a question, what are Momentum's Group distinctive advice narratives to drive growth? So let's start off with that first question. What are some of the findings from the Momentum-BMR Household Financial Survey on financial advice? One of the key findings here is that 77% of South Africans rely on their own knowledge, skills, or experience, which means that there's a relatively small percentage that actually make use of financial advisors. In fact, only 9% of households make use of professional or certified financial advisors for financial advice. Also, what we've seen here is that only 39% of households earning more than 40,000 per month make use of a professional financial advisor, although this is the specific group that can actually gain quite a lot by making use of a professional financial advisor, as we'll see from this presentation. The question now is that, but does advice from certified or professional financial advisors add value to households? And the answer to that is a resounding yes. Namely, we found that among those households that do make use of certified or professional financial advisors, that their net wealth is about 9.5 times larger than households without certified or professional financial advisors. We've also seen here is that the various products that actually gain from financial advice is not just certain financial assets, but a wide range of financial assets, including growth in deposits, pension, long-term insurance, as well as investments. The question can then be asked, but if advice is so valuable that those households that do make use of certified financial advisors, that their wealth is 9.5 times larger than those not making use of certified or professional financial advisors. Why are such a lot of South Africans not getting financial advice? And there's a wide range of barriers. The first one is that from the research that South Africans generally do not know what a financial advisor does. South African households generally do not have sufficient money to invest. There's also problems with the affordability with respect to products and advice. A lot of South Africans indicated that they do not know where to find a financial advisor. There's a perception that it's only for the rich. Quite a lot of them indicated as well that the current financial solutions do not meet their needs. A big issue is the fact that a lot of South Africans do not trust financial advisors, and South Africans generally are not very financially literate. And as we're going to see later, that only about 14% of South African consumers, adult consumers, are sufficiently financially literate. The question can now be asked, but the people that do seek financial advice, why do they seek financial advice? For the bulk of them, it's not to optimize their wealth, but rather to address pain points. And those pain points include financial or economic challenges that they are experiencing. When there's regulatory changes, and that's, for example, with respect to the two-pot system, that a large number of people that generally don't make use of financial advice access the financial advisor in order to access a part of their retirement savings. When there's personal financial challenges, and as we'll see later on, that's especially with respect to when they are deeply indebted. And also technological and educational advancements are making it possible for more and more people to access financial advice online. When we ask consumers, what do you expect from a financial advisor? The following results were obtained. Consumers indicated that they want financial advisors, firstly, to understand them, their context, as well as their needs. Also, that financial advisors would actually analyze their needs and then apply an objective lens not driven by personal or company agenda, being open, honest, and driven by integrity, and very important to be knowledgeable with a good understanding of various solutions and products. Which channels do South African households use to receive financial advice? At the moment, it's mostly face-to-face, although virtual meetings, online chats, and even robo-advice are currently being increasingly used to access financial advice. The one thing that we also need to understand is that when you look at the digital device usage of South Africans, digital banking is increasingly being used. And just remember that 88% of South Africans at least have some kind of a transactional account. And we're seeing that a growing percentage of them are accessing those services online. And we're also seeing that digital banking is becoming more and more prevalent in the way that people are conducting their banking. The implication of this is that there's a huge market out there for people to use services and advice online, digitally. And we're also seeing that an increasing number of people are actually going online for advice at the moment, not necessarily to financial advisors, but often to social media, to influencers, also to a variety of websites. Let's go to the next question. Given everything that I've indicated with respect to the findings of the surveys, how should the Momentum Group define advice and its various dimensions? The one thing that is important to understand that when it comes to the definition of advice, we have to realize that advice is ubiquitous. It's everywhere. People are continuously accessing advice from friends, families, colleagues, influencers, even as strangers online, from WhatsApp groups, etc. So, but although the concept of advice is widely understood. Financial advice and the role of the financial advisor is not really understood. And it's very, very important to bring that also into the mainstream of understanding. When you ask the consumers, what would they need advice on? One of the first things that came up was debt, because South Africans are generally very highly indebted, and it's just clear from the fact that when you look at credit active consumers, that 47% of them have defaulted on their credit servicing. Also, a huge need with respect to information on budgeting and cash flow management, estate planning, retirement planning, investments, savings, risk protection, and tax efficiency. And as you can see from this, the need is very holistic. And holistic financial advice in this context can be defined as professional advice that helps individuals or businesses make informed financial decisions to achieve specific financial goals with respect to debt management, budgeting, cash flow management, estate planning, etc. Everything that's indicated in that specific circles. At the moment, we're also seeing that when you look at the need of consumers with respect to financial advice, these expectations are shifting, and technology, new products, etc., is giving fuel to this shift taking place at the moment. One of the first things that consumers expect with respect to financial advice, that is simple, that it's there when they need it, that it's being given with empathy, not, for example, as part of a product push or to criticize, and that it's really relevant for their situations. But that then also means that the role of the professional financial advisor is advising, is actually evolving in order to meet that changing expectations of consumers. And what's very important here then is for the financial advisors to bridge that gap. Firstly, there's an informal financial advice that people are getting at a wide variety of places, to formal advice, and to be present where people are already seeking advice, namely digital platforms. And we'll later see that from what the competitors are doing, that there's an increasing move towards these digital platforms to meet the consumers where they want to be met. When we look at value, we've seen objectively that consumers that do make use of financial advisors are much better well off than households without advisors. However, that when you look at the definition from the consumer perspective with respect to the value of advice, it's not just objective. It goes to firstly issues such as trust. And we've seen at the moment that trust is fragmented. There's trust for a wide variety of sources. We're also seeing that people are becoming much more skeptical of the advice that's been given to them. And we're also seeing at the moment that the relationship is absolutely at the core of the value of advice. And we also found that advice should be relatable, and also that quite a lot of consumers remain concerned about the costs of advice. So we would have expected that their major focus would be as to what they can benefit from advice in the sense of better investments, but the actual focus is on the cost, and quite a lot of them indicated that affordability issue is still very, very important for them. When we start looking at the competitor landscape, the question could be asked, how is advice leveraged by competitors, and where are the open spaces? And it's very important to take note of the fact that the competitors are evolving very rapidly at the moment. We're also seeing that the competitors are increasingly using technology. They're also using other techniques such as mass advice for affordability. And also it's just that there's a much bigger focus on holistic financial advice, much more on fintech innovations, also using apps for those purposes. Also here is that we're finding that competitors are increasingly focusing on environmental, social, and governance principles. And especially the focus on governance principles is important because of trust issues of consumers, given that there has been quite a lot of events on social media and on the mass media with respect to people that have taken investments from consumers, but those were people that were not registered as financial advisors or financial institutions, etc. But it's right in the faces of quite a lot of people, and so therefore the governance issues is also incredibly important. Just to summarize what I've indicated thus far. So we're seeing then that the open territories being provided for us in the way that consumers actually want advice is that they want holistic advice, that we should meet them with respect to technology, ensure that they can access advice, that there's financial education being provided as part of the offering, and also that that principles of ESG or environment, social and governance are being met. So the question now is that given that advice could be very valuable to consumers, how can the Momentum Group make advice more accessible? There's certain barriers that consumers have got that is basically negatively impacting on that accessibility. And that include that South Africans don't know what the financial advisor does. As I've indicated earlier, they indicate that they don't have sufficient money to invest, that is not sufficiently affordable. There's a perception that advice is only for the rich, and also that trust issue of not trusting advisors. Also here is that we've seen that one of the main reasons for the affordability problem is the fact that South Africans are so incredibly deeply indebted. And what's very important here when we look at the debt situation is that we've seen, for example, here that people with a monthly gross income of about 20,000 to 30,000, that about 31.7% of their gross income goes towards debt servicing, and that goes up to about 36.5% for people earning 30,000 to 40,000, and also for people earning 40,000 to 50,000, it's about 34.5%. This has got two implications in the financial advice space. Number one is that the fact that people are so deeply indebted and that they have to pay that very large sum every month to service debt ensures that they don't have sufficient money to invest and to buy a variety of financial products. The other implication is that this is top of mind for people. And this is a specific area where they actually desperately need financial advice, where financial advisors with which they can relate can actually provide for them solutions in this regard. So how can a financial advisor then step into this space and to provide that financial advice that will really pull consumers closer to them? The first part here would be to build trust and credibility by showcasing value. And that, for example, is simply by showing people how they can benefit from financial advice in the sense of being able to retire, having a bigger portfolio, etc. Also, to provide personalized financial planning, and debt is a very, addressing debt is a very big part of that. Providing financial education, also providing more digital channels, and then also very important is to provide behavioral nudges to ensure that people are being nudged towards specific solutions, cross-selling, and then also to provide that different channels to make financial advice more accessible. The one thing that we, however, have found is that when it comes to accessibility, one of the biggest problems is that people don't know. I've indicated earlier that only about 14% of adults were found to have a sufficient level of financial knowledge to engage with their own portfolios to actually ensure that they can over time grow those portfolio. So it'll be very important for people to have a higher level of financial literacy to become able to become more engaged also with financial advisors and in growing their own portfolio. What we found is that financial literacy is a key enabler on this road of people to access advice. And also is that because when people become more financially literate, they will know what a financial advisor does, where to find them. So advice-seeking behavior will increase. And that also when they know about all the checks and balances and about certified financial advisors and the role of the FSCA, the Reserve Bank, the National Credit Regulator, that they will become more trusting towards the advice that's being given to them. So let's just focus very quickly on the underserved market in South Africa. As indicated, is that there's a huge percentage of South African households that don't make use of a financial advisor. The bulk of them are in the poor space, and also is that 91% of households who use financial advisor as a matric or higher qualification, which means then that people with a lower level of education, with lower incomes, have got a lower use of financial advisors. The way to engage the underserved market is often with holistic financial advice, and this is advice that's not so much focused on providing a specific financial product to the market, but actually to ensure that the people in the mass market become more able to know what financial advisor does, to take control over their own finances, to for example, access a financial advisor, etc. To access that part of the market, it will be very important to understand that those people are experiencing a lot of financial challenges. There's a very high level of financial vulnerability. So the bulk of the holistic advice will basically be to build a relationship and to educate people with respect to their finances. A very nice way to understand this is going back to Maslow's so-called motivational hierarchy. And as you know from that hierarchy, Maslow indicated that people have got a variety of needs, from basic needs, and those basic needs include things like obtaining food, obtaining shelter, to safety needs, to esteem needs, to self-actualization needs on top. And the same is exactly the same with respect to the underserved market as well. The focus of the underserved market is mostly on basic needs, and it's very important, therefore, to meet them on their level of needs. It won't help them to provide, for example, products right on the word go that will provide financial freedom or legacy products, etc. It's there to, it should be focusing on how to improve their basic needs, and this includes things like budgeting, financial planning, etc. What we've also seen in the research is that quite a lot of respondents indicated that they've benefited from advice by advisors telling them, where can I access social grants? Where can I access, for example, an RDP house? So it's providing basic information with respect to their basic needs that help build that trusting relationship. Also here is that when you look at the challenge then is that there's a difficulty reaching underserved markets. And what we've seen in this regard is that this market could be accessed by, for example, reaching out to that market. But the question is, but how do I reach out to them? One of the biggest benefits at the moment is the fact that the underserved market is highly subscribed to internet products. In fact, we've seen, for example, that more than 60% of the underserved market have got smartphones. So that also makes it possible to reach out digitally to this market. And just in conclusion then, bringing everything together, what can be the Momentum Group's distinctive advice narrative to drive through to growth? When we look, for example, at the various questions to be asked, and I'm just going to run very, very quickly for them. There's a lot of questions that we have to ask when looking at this narrative. Namely, firstly, what is the needs state map for advice? What is the role that brand, financials, advisors, and clients play within the advice relationship? Are there seasons related to advice? Namely, for example, seasons could, for example, be that when people first enter the relationship, that there's a focus more on holistic aspects, financial planning, budgeting, financial literacy, moving later on to, for example, financial products. What are the hygiene factors for advice? And the hygiene factors in this regard refer to those basic things that should be in place to make the advice situation possible before people are being moved into a situation where they will access financial advice. And also, what is the real value of financial advice to a client? When you access people to ensure that you can build that advice relationship with them, at the core of everything is this trust equation. And in this trust equation, you will notice there that when you look at trust, is a function of credibility, reliability, intimacy, mediated by self-orientation. It seems complex, but let's just have a look at that. So that would then mean is that, firstly, is that it's very, very important that the advisor, in order to obtain a bigger market, is seen as being credible. And being credible in the sense that excellent advice is being provided. Also, that the person is being seen as not just pushing a specific product, that there's a real concern for the needs of the consumer, and also that that relationship is being built. There should be reliability in the sense, for example, that the consumer can see that this person can be trusted. Also, it's just that the advice that the person have given have got long-term positive results. And also then the third factor there is intimacy in the sense, for example, that there's empathy in the relationship, that there's a caring relationship, and that there's also a real reach out to the consumer. But it's being mediated by the self-orientation of the advisor. And this is something that's fascinating in the sense that we found in our research that consumers pick up very quickly the level to which the advisor is, for example, orientated to improving their own financial well-being versus the financial well-being of the consumer. So an optimal relationship would be where the self-orientation of the advisor is lower, so the emphasis therefore is on the well-being of the consumer, that the advisor is seen as credible, as reliable, as a person that's really got empathy. So this is the optimal solution that we found. And this basically sums up the whole presentation thus far, indicating for you, for example, that there's such a lot of opportunities. There's such a big unserved market for advice. But it's very important that we not just have the good products, but we also do it in the correct way where there's a high level of trust. Thank you so very much for this wonderful opportunity, and I wish you all the best in your further role as a financial advisor. Thank you.
Thank you, Prof. Carel, and thank you to all our speakers today. We've seen once again how powerful advice becomes when supported by the right solutions, and how our MFP flagship fund range, including the new MFP Focus Unconstrained Equity Model Portfolio, are designed to help you deliver those outcomes. Thank you for joining us for this edition of Outcome Matters. We look forward to seeing you at our next session. Until then, keep leading with confidence, because in advice, every outcome truly matters.